$84. That is what COMEX says silver is worth right now, down from 121 in January, down 30% from the all-time high. And if you watch CNBC, if you read Bloomberg, if you listen to the talking heads on financial television, they will tell you silver is crashing, that the momentum trade is broken, that you should be worried, that maybe, just maybe, it's time to sell. Now let me tell you what those same institutions are saying behind closed doors. Citigroup, one of the largest banks on the planet, published a note this month raising their silver price target to $150 per ounce within 3 months. Not 3 years. 3 months, $150. That is an 80% gain from today's price. Bank of America's head of metals research, Michael Widmer, has a target of $309. $309. That is not a typo. That is nearly 4 times the current price, published in an official research note by the second largest bank in the United States. And Deutsche Bank says the gold-silver ratio at 57 reflects, and I am quoting their analysis, significant upside potential with a long-term forecast of $100 per ounce as a floor. So let me ask you the question that nobody on television is asking. If the biggest banks in the world have internal targets of $150 to $309, why is the price at 84? And more importantly, who is buying silver at 84 while telling you to sell it? Because that is exactly what is happening right now. JPMorgan took delivery of 99% of all COMEX silver in January, 8.1 million ounces, at prices between $74 and $90. They loaded up during the crash that their own margin system helped create. And now, while the financial media runs headlines about silver's collapse, the physical market tells a completely different story. Shanghai premiums are running $10 to $15 above COMEX spot. Indian premiums flipped from a $50 discount to parity in 48 hours after Dubai went dark. Dealers across the United States are reporting product shortages and widening premiums on physical coins and bars. The screen says 84. The banks say 150 to 309. And the physical market says you can't get it at the screen price anyway. Something doesn't add up. And in this video, I'm going to show you exactly what's happening, who's behind it, and why the next 60 days could be the most important window for silver investors in the last 44 years. Let me walk you through each bank's position because the details matter more than the headlines. Citigroup upgraded their silver forecast in late January, right before the crash. Their analysts wrote that they expect silver to reach $150 in the second quarter of 2026. Their reasoning is straightforward. They point to continued strong buying momentum in China, persistent physical tightness in major trading hubs outside the United States, and what they describe as strong investment and speculation demand. The key phrase in their note is further physical tightening. That means they see the supply getting worse, not better. Bank of America's Michael Widmer took a different approach. His $309 target is based on the gold-silver ratio. Right now, gold is trading above $5,000, and the ratio sits near 61 to 1. In 1980, when the market last experienced a supply crisis of this magnitude, the ratio compressed to 17 to 1. If it compresses to 20 to 1 at current gold prices, silver hits 265. If gold goes higher, which JPMorgan itself forecasts to 6,300 by year end, and the ratio compresses, 309 becomes not just possible, but mathematically inevitable. If you own silver, or you're thinking about buying, subscribe and hit the bell right now. Because what I'm about to reveal next is the part the banks hope you never connect. Now here's what makes this moment unlike any other. Keith Neumeyer, the CEO of First Majestic Silver, one of the largest primary silver producers on Earth, has been saying silver would hit $100 for over a decade. When he first made that call in 2017, silver was $17. People laughed. In January 2026, silver hit 121 and he was vindicated. And now, with silver pulled back to 84, he's not backing down. He's doubling down. Because the fundamentals haven't changed, the deficit hasn't closed, the vaults haven't refilled, the industrial demand hasn't slowed. The only thing that changed is the paper price. And the paper price is set by margin requirements, not by supply and demand. Larry Lepard, one of the most respected sound money investors in the world, has said publicly that $100 is a minimum, not a ceiling. His thesis is simple. Silver has been in a structural deficit for 6 consecutive years. Cumulative shortfall, over 800 million ounces. Mine production is flat. Industrial demand is accelerating. Solar panels, AI data centers, electric vehicles, semiconductors. Every technology that defines the 21st century requires silver, and there is no substitute at scale. At some point, the deficit forces a repricing, and that repricing won't be gradual, it will be violent. Because the market that's been suppressing the price, the paper futures market, will be the same market that amplifies the move when it reverses. Now let me show you why $84 isn't a crash. It's a setup. Because we've seen this movie before, and it was only 2 months ago. In late January, silver was trading around $90. It pulled back to 78 on a margin hike. Then it exploded to 121 in less than 2 weeks. A 55% move in 12 trading days. The catalyst wasn't some magical news event. It was the market finally pricing in what the physical market had been screaming for months. There isn't enough silver. Right now, the setup is almost identical. Silver has been pushed from 96 to 82 through a combination of margin hikes, dollar strength, and war-related liquidation. The paper market has been flushed. Speculative longs have been wiped out. Retail traders are demoralized. Financial media is running, "Is silver done?" headlines. This is exactly what the bottom looked like in late January. And the fundamental picture today is actually worse, meaning more bullish than it was then. Here's why. In January, COMEX had about 95 million ounces of registered silver. Today, it's 86 million. 9 million ounces drained in 6 weeks. In January, Dubai's bullion air bridge was operational. Today, it's shut down by an active war. In January, China's export controls were brand new and untested. Today, they've been in effect for 2 months, and the pipeline is visibly tightening. In January, there was no shooting war in the Persian Gulf. Today, the Strait of Hormuz is effectively closed and 150 tankers are sitting idle. Every single variable that drove silver from 78 to 121 in January is present today and amplified. The deficit is deeper, the vaults are lower, the supply chains are more disrupted, the geopolitical risk is higher, and the price is lower. That is not a bearish signal. That is a coiled spring. And here is the number that should stop you cold. The COMEX March delivery cycle has 52 million ounces standing for delivery against 86 million registered. That is a 60% claim on total registered inventory in a single month. February set an all-time delivery record. January was 7 times normal. Traders are not rolling forward. They are demanding physical metal, and the metal is running out. So let me put the full picture together, because once you see all the numbers in one frame, the disconnect between the price and the reality becomes almost absurd. The price says $84. Citigroup says $150. Bank of America says $309. COMEX registered inventory is at a 20-year low, 6 consecutive years of supply deficit, 800 million ounces of cumulative shortfall. China has gated exports through 44 companies. Dubai's air bridge is shut down. The Strait of Hormuz is closed. March COMEX has 52 million ounces standing. JPMorgan took delivery of 99% of January notices. Physical premiums in Asia are running double digits above spot. And the CME has hiked margins multiple times to keep the price below 100. Now ask yourself, if you were an institution with a $150 target and you could buy at 84, what would you do? You would buy everything you could get your hands on. You would buy quietly. You would use the crashes you helped engineer to accumulate at prices you know are artificially low, and you would tell the public to sell, because every ounce they sell is an ounce you can buy. This is not conspiracy theory. This is exactly what the COMEX delivery data shows. JPMorgan didn't take delivery of 8.1 million ounces in January because they thought silver was overvalued. They took delivery because they know what their own analysts know. The physical market is tighter than at any point in modern history, and the paper price is a fiction maintained by margin policy. Here's the question for you, and I want you to actually answer this in the comments because this community's analysis is consistently sharper than anything on financial television. If Citigroup's 3-month target of 150 is correct, and you're sitting at 84 today, that is a 78% gain in 90 days. If Bank of America's ratio-based target of 309 plays out over the next 12 to 18 months, that is a 267% gain from today's price. And the risk is that silver falls further before it recovers, which is exactly what happened in January before the 55% spike. The institutions have told you their targets. They published them. Citigroup, Bank of America, Deutsche Bank. JPMorgan's own research sees silver averaging 81 with upside to 100. The FX Empire analysis shows a cup and handle pattern targeting 250 to 300. 57% of retail investors surveyed by Kitco expect silver above 100 this year. The consensus among the people who actually study this market professionally is overwhelmingly bullish. The only thing that's bearish is the paper price, and the paper price is set by the same institutions that are buying physical metal at every dip. Let me bring this to you directly, because this isn't about charts and ratios for the people watching this video. This is about whether you're going to act on information that the biggest banks in the world are acting on, or whether you're going to let a number on a screen convince you that the opportunity is gone. Silver at $84 today is silver at $17 in 2020. It's silver at $8 in 2008. It's silver at $4 in 2001. Every single one of those prices looked like the wrong time to buy. Every single one of them preceded multi-100% rallies. And every single one of them happened during a moment when the financial media was telling retail investors to sell while institutions were quietly accumulating. The difference between now and those moments is the supply picture. In 2008, there was no structural deficit. In 2020, there was no physical shortage. Today, there is both. The largest deficit in history colliding with the most disrupted supply chain in modern precious metals history. And layered on top of it, a shooting war that has closed both the primary air route and the primary sea route for moving physical metal from west to east. I want to be honest with you about what could go wrong. The CME could raise margins again, the dollar could strengthen further if the war escalates, a ceasefire could reduce safe haven demand in the short term. Silver could touch 75 before it touches 100. These are real risks. But notice what every one of those risks has in common. They are paper market risks. They affect the futures price. They do not create a single ounce of physical silver, and they do not change the fact that the deficit is real, the vaults are draining, and every major bank with a research department has a target dramatically above the current price. Here's what's in your control. Not the CME's margin policy, not the war, not the bank's trading desks. What's in your control is whether you understand what $84 actually represents in the context of $150 to $309 institutional targets, a 6-year supply deficit, and the most disrupted physical market in 4 decades. Every crash in silver's history has been followed by a rally that made the crash look irrelevant. 1980, silver crashed from 50 to 5, then the market grew for decades. 2011, crashed from 49 to 14, then began a decade of accumulation. January 2026 crashed from 121 to 74, recovered to 96 in 12 days. We are sitting at 84 right now. Citigroup says 150 in 3 months. The vaults are at 20-year lows. Dubai is locked. Hormuz is closed. China has gated exports. And every major bank is publishing targets that are 2 to 4 times today's price. The question isn't whether silver is going higher. The banks already answered that question in their own research notes. The question is whether you will be positioned before the paper price catches up to physical reality or after. And if the last 6 months have taught you anything, it's that after arrives very fast. It took 12 days to go from 78 to 121. 12 days. The window doesn't close slowly, it slams shut. And when it does, the price the screen shows you will be a number you wish you had acted on when you had the chance. $84. Remember that number. Because every analyst at every major bank on earth is telling you it won't stay there.